Today is March 21, 2:43 p.m. We saw something very unusual on eBay and wanted to report it here. These unusual options require a lot of buying power. So at the end of the video, we're going to show you a trade that requires less buying power so you can get in if you decide it's right for you. So let's take a look quickly at the unusual options here. Keep in mind low IV 5%, and which will be important as we construct a trade. Here you'll see at 11:55 we have these April 21s. There is this unusual 6,000 contract selling the 35 puts, right? And then this is here 42.5 puts. This is the 3,000 buying that and selling that. So this is a back ratio, and you'll also see it here in the chain on April 21. It's 31 days out, and here it is, the 6,000 here on the 35 strikes and the 42.5 strikes. So what we want to do now is look at the analysis of this trade. This is what it is here, and you'll see right now it costs $95 to get in on this trade. However, because you're also selling the 35 puts, two of them, you're going to need a lot of buying power. Each one is going to require you 3,500 of them. So since we had 6,000 of them, this unusual options, they were selling 6,000 of them, that required close to $21 million just to put on a trade like this, because they're essentially promising that they will buy eBay for $35 if it drops below that at expiration date. So they have to have that much money to be able to buy that. So that requires a lot of capital, and so most of us don't have that. And so what are we going to do? This is again a short position. So here is something that before we go to that, the trade we thought of that requires less. If we look at this trade, you'll see that it's a negative delta trade. You'll see here a negative theta trade and a positive vega trade. So keep that in mind as we put on these our own option. So this is the trade that we think would be good. Let's take that off. This is it's a diagonal trade. It would, if you only have a small account, these only cost $72. You don't need that 3,500 to well, actually you need 7,000 since you need to sell two of them. So with this trade, it's actually buying the same puts here as this one, right? But instead of selling two of these 35 puts, we're going to sell the 41 put on a different date on April 6th. And if you look at the this trade, it's also a positive vega trade, and it's actually not a negative theta, which is good. It's closer to zero. We don't prefer not to have a negative decay in time, so that's why we like this trade. It's not a negative theta decay, and you still get that negative delta. And this one's at negative 16. So you can put many of these on. You can do two of them, and that would only be $140, about $144. So you can adjust it based on how much you want to trade with, based on your account size and your risk tolerance. So that's why we like this trade. And if we look at the chart, the reason why we picked 41 as the put is also because when we look at this chart here, you'll see that here on March 15, the that day the price actually hit about $40 here, and then it just came up to about 41, right here 41. So it didn't close that day. It had a strong support at 40 and bounced right back up on that day. So that $41 here is acting as quite a strong support here that we believe. You also see here at the end of the year it was around that range level. So we like to sell that 41 put there to reduce our cost basis. And if you notice here, eBay is currently here. It's a little bit oversold on the stochastic oscillator, and also the volume is decreasing. So while this momentum is going up, the volume is decreasing. So we are concerned that the momentum is dropping off. So that's why it is possible, highly possible, that the direction of eBay is that it's going to go down and it's not going to continue to go up. Another kind of technical reason, if you do technical analysis, is if we pull a Fibonacci here from this downward trend, you'll also notice that we're getting close to the 61 point. This is the 61% level. You'll see here the 61% level here. So this level here is the 61%. So it's about there. So once it hits that level, there's going to be a strong resistance level here to try to surpass. So that's why we think it may just bounce off of this Fibonacci, and that's probably why the large institution also took a short position using the back ratio strategy, which minimizes their cost in case it actually rallies. So that's one of the reasons why they use this higher buying power strategy. All right, but if we don't have as much, we can use that trade, the diagonal put spread that we showed you. All right, so yeah, if you like this video, give us some thumbs up, and we can continue to make these videos for you. And subscribe and hit the bell icon, and you'll get notified when we see these unusual options. Thank you, and take care, everyone.